Hello, everyone, and welcome to the African Leadership Connect. My name is Michael Nanayaunimo, and I'm going to be your host. On today's episode, we will be talking about debt. Basically, we are going into understand what is debt, how to calculate your debt to income ratio or DTI, whether debt is important, and then most importantly, how to deal with debt. As I've mentioned earlier in some of the previous episodes on this particular season, where we are looking at how to manage your personal finances, money is a topic that I keep reiterating, that young people are only interested to know how do I make money, but they don't know how to manage their money. That is why I'm dedicating this whole season to understanding personal finances and understanding some of the key topics related to managing your personal finances, to make sure that at the end of the day, you not only know how to make money, but you know how to manage what money that you have, and even how to multiply it and make it work for you. That is why for this season, we are looking at how to manage your personal finances. In the first episode, we had a look at how to manage the basic understanding. We had a look at the basic understanding on what personal financial management is. And then in the second episode, we had an in-depth discussion about budgeting. So for today, we are going to talk about also a very important thing that affects the lives of almost everyone, and that is understanding debt. And I've already mentioned we are going to look at what debt is, and then a few other things concerning debt, so that at the end of the day, you can appreciate what debt is, and if you're in debt, how to get out of it or how to manage your debt much more efficiently. As we all know, the Christmas season is over, and right after Christmas is another season. For those who have children who are still schooling, we've entered the season of school fees, and you can see that during the Christmas period, a lot of people had to spend money. A lot of people enjoyed their Christmas festivities. Some people even took loan to be able to buy certain things for their family to take care of them. And we've entered into another season whereby, January is like the longest month in the year. Like, sometimes I feel that January on its own has 3 months in it. And because people receive their Christmas, their December salary somewhere in the middle of December, they have to spend over 45 days before their salary is paid, especially those who are on salary at the end of January. So this makes a lot of people go into debt. For example, a lot of people borrow money just to cater for school fees, so that when their salary comes, they are able to start repaying and things like this. That is just to give you an example of how debt is around a lot of people's lives. And that is why it's very important for us to understand the concept of debt and then see how we can navigate around it. It is therefore very important for us to understand what debt is and how it affects our lives. And I just want you to remember that this is just an introduction to debt. I'm not going to go into too much details about personal debt, but just to give you an intro to debt. Based on feedback, we can have a much more detailed discussion about debt and how to get out of it. So, I don't want to waste much of your time. Let's just go straight into what debt is and how we can deal with debt. So, the big question: what is debt? What do we mean when we say personal debt or when we say debt? And for the purpose of this discussion, or for this discussion, I will say personal debt is defined as debt that is owed as a result of purchasing goods and services for individual and household consumption, such as if you took a loan from the bank to pay school fees. You have your student loans that you took whilst you were on college and you are still paying for it. Mortgages on your house, house rent, car loans, payday loans, and all those kind of things that you've taken for your personal or to consume as a household. These are all the things that you can define them as personal debt. And you have to know that personal debt does not involve debt that you have taken to run a business, because now that is a separate discussion, because that debt you've taken, it's going to help run a business, which will in turn bring in some income or revenue to help pay off the debt and then to make you some good returns. So when we are talking of debt in this scenario, I'm talking of personal debt, and it does not include any form of business loan or loans taken for investment that is going to bring you more returns than what you've gotten plus the interest that you are paying. So I hope this definition is clear. Take note of it. It's about the debts that you've taken for your personal or household consumption. So if you've taken any sort of debt, whether you wanted to buy a TV, you did not have the full amount of money, you decided to take some payday loan and then pay it off in 2 or 3 months time, or you needed a new laptop and you did not have enough money, so you took a loan to pay off that, or to get a car, you wanted to buy a car, you did not have the full money, so you therefore had a deposit, or you took a loan to buy that car for your personal use or for the use of your family. This is then what we are going to define as debt at the personal level. So now that we understand what personal debt is or what debt is, a very important thing I would like you to know, concept I would like you to know at this moment, is what we call the debt to income ratio, or DTI. This in definition is a way to assess your debt, to know that what percentage of your income or expected gross income is in debt or is going towards your debt. So in a very rough definition or explanation, it's an assessment tool that helps you to know your performance in terms of debt, how much of your expected income will go into repayment of debt. If the ratio is high, it's not good news. Although there's not been a specific or single indicator of debt, that debt is going to ruin your life, but then the DTI, or debt to income, is able to help you sort of assess yourself that, okay, what percentage of my income or expected income is going towards my debt. And then based on how high or how low that percentage is, it gives you an idea on how you have to manage your debt or your current situation when it comes to debt. So for let's say, for example, someone earns, let's say I earn $1,000 monthly as my gross salary, and I have no extra income. So this is my entire income, or my entire expected income in a month. And then let's say in December, we've had all the festive occasions, everything is done. Now I have school fees. Let's say I have 2 kids or 3 kids who have to go back to school, and I have to take them to school. But since I don't have cash now, I decide to take a loan of, let's say, $800 that I'm going to pay in 6 months at an annual interest rate of, let's say, 15%. So that means that roughly every month for the next 6 months, I have to pay $143 towards that loan that I took for school fees to make sure my kids go to school. So that is one expense. On top of this, let's say I have a monthly rent of $120, which I'm having because I have a family. It's maybe a 2-bedroom place outskirts of the city, and I'm paying $120 every month. And then I also have a car loan, like my family needs to move, I have to drop my kids at school, I have to drop them at my wife at work, or my wife has to drop me at work and continue, but we need a car for the family. So I took a car loan, and on this car loan I'm paying $150 every month for the next 2 years to recover, to pay for that car loan. Yeah. So on average, when you put everything together, we are looking at roughly about $413 going into debt repayment, and then paying off debt or paying off things like that. So on average, I'm looking at $413 out of my $1,000 that I am going to pay. I'm going to earn. Sorry, I'm going to earn. So now when you divide the 413 by the gross salary of $1,000, you have about 41% of your salary going into debt repayment. Then now let's say I'll use an example of Uganda. The average, if you're earning like $1,000 or so, your average pay as you earn tax with all these other deductions comes roughly about 30%. So you take out $300 out of the 1,000. At the end of the month, you are left with actually $700. Now, if you divide this 413 by $700, you are going to get about 59% of your monthly net income going towards paying debt. That is an example of what a debt to income looks like. So now I know if I'm getting $1,000 as gross, my DTI on my gross is about 41%. But if I take what actually the disposable income, what I actually have to spend, I'm looking at spending roughly 59% of my net income going towards paying debt. So my DTI ratio is 59%, which is very high. So this now gives me an idea about where I currently am in terms of my debt. Then I can now ask myself questions like, okay, how do I move from, let's say, 59% to, let's say, 35%? 35% is what the experts say is a very manageable ratio to have. But then that will depend on your circumstance, your lifestyle. But then they claim that at 35%, it's manageable. It's okay. You can manage it when 35% of your income goes towards repaying of debt and things like that. So let's say your target is to maybe move from 59% where I currently am to that 35%. Then I'm able to ask myself the right questions like what aspects of these things, these debts that are really not necessary or that we can do with in the short period of time or in the medium term to reduce my debt, so that I can use that money to take care of some other things in my life. Now you are beginning to ask the right questions on how to manage your debt, because you've seen from the DTI calculation that your debt ratio to your income is very high. So that is an example of the DTI and how it actually works in real life, or how you can use it to find for yourself what your debt to your income ratio is. So a lot of the experts are using the gross income, and you can see from my example, I decided to go one step further and talk about the net income, because in Africa here, before your gross salary comes to you, the government has taken their part. Some statutory deductions have gone, like pension and things like that. You have your pay as you earn, which is the income tax that you pay on your salary or on your earnings. So I find it more practical for me to use the net income as a good indicator of my DTI, because now it gives you the real situation on the ground that, okay, if I'm actually going to have $700 in my hands, and now I'm going to spend 413 of that to take care of these debts, then I know what I have left, because that is the cash I have in my hands. And in Africa, I know this is the most practical way for us to calculate our DTI. Now that you know about DTI and how to calculate it, let me remind you again how to calculate it. Take now your net income. How much salary are you earning? How much income is actually coming into your hands at the end of the month? Then divide it by how much you are spending on loans or other things, like things you have to pay for, like your loans. add them all together and then divide it by how much money, disposable income or net income, that you are actually going to get, and then see what your DTI is. Then the question becomes, if for example you do the calculation and it's above the 35%, at least now you know. Now you are able to ask yourself questions like, okay, now that my DTI is high and is above 35%, how do I get it back into a reasonable range? That is the whole purpose of understanding the DTI, because it makes you ask the right questions. Now, I hope you get what I mean when I say DTI is a very good indicator of your debt as an individual or as a family.